Welcome to today's webinar of the South Niagara Chamber's live stream series. Thank you to Dolores Fabiano and her team for setting this up, the Niagara Falls Small Business Enterprise Center for hosting this nice event, and thank you to the audience for your participation and dialing in today. My colleague here, Steve Helwig, and I will present what lenders are looking for, understanding, not necessarily agreeing with your financial institution webinar. I'm Volker Loetfering. I'm the Business Loans Officer with Venture Niagara, a Community Futures Development Corporation, nonprofit organization, and I have about 5-6 years in lending as a background, plus a lot of business development, marketing, and sales management in different verticals, industries like distribution, manufacturing, finance, retail, as well as market research.
My name is Steve Helwig. I'm the office manager at the Business Success and Loan Center in beautiful downtown Fort Erie. I've been there for 5 years. We offer business consulting and we do lending as well. I was 30 years in banking, and a number of those years were in business banking as well. What we're going to start off with, the title of this, what lenders are looking for. So how you can present to someone you're looking to borrow from for your business. So this is how financial institutions assess the credit worthiness of a business. And financial institutions can include our own institutions, Venture Niagara and Business Success and Loan Center, banks, trust companies, anyone that has money to offer to businesses. And I'll just generalize as there are one distinction between lenders. Some are cash flow lenders and some are equity lenders. We're probably going to talk more on the cash flow side of things. So what you do to start off with is communicating your business ideas to your banker or to your lender. You shouldn't use the term banker, to your lender. So lenders depend on something called financial ratios, which are taken from your financial statements. An example are some key ones are debt to equity ratio. That's how much debt you have compared to how much money you have invested in the business. Or profit margin. What's the percentage of your sales that are profit? Credit assessment is common sense. It's just assessing the risk of the loan presentation in front of the lender. Financial institutions apply the same process to granting credit as you might grant it to your clients. Or if someone were to ask you personally to borrow, they want to borrow money from you, what things might you consider in doing that? So again, the process is risk assessment, which we do every day. We assess risk in all areas of our life, and that's what lending assessment is about.
Okay, and I forgot to mention, if you have any questions throughout the presentation, feel free to submit them through your comment box. When you meet with your lender, one of the important things is to understand them. Having worked in the banking industry, a couple key things which come up is the KYC, what they call the Know Your Client. They want to know you. You should also learn about your banker, your lender, and build a rapport with them. One of the acronyms they use is FORM. They will talk about family, they will talk about occupation or your business, they will talk about the recreation, so they want to know and get a feel for you, and as well as the message or the money and motivation behind your business.
The next section we're going to talk about is the business plan. Your lender can be looking for a business plan, especially if you're a new business. That's going to convey your business values, your ideologies about the business. It's a roadmap for business to follow. Tells us what works and doesn't work. I have heard a lot people saying that they need to do a business plan for the bank. First and foremost, the business plan is for the owner. It gives you a direction of where your business is going. And the key to the business plan is that it's what successful businesses do. In preparing the document, that's to be done by the business owner. It can be done in consultation with different people like your accountant or bankers, consultants, industry partners, getting information, say, from the Chamber of Commerce, networking group, family and friends, and clients. But most importantly, the owner needs to know the business plan. If you don't have a business plan, organizations such as Volker and the one I work for, we can help you with that.
Yes, exactly. And a business plan is a living, breathing thing. So after the first initial setup, after a couple of years, you will want to go back and see, have you achieved what you set out, right, in the plan, or where you have to make adjustments. And one of the part of the business plan is the cash flow forecast. So with the cash flow forecast, it's probably one of the most important documents management and we as lenders or lenders are looking for. They want to see, what do you project? How do you sell? What of quantity of your products or services are you selling at what price? So look at what your revenue is, as well as then what are your cost of goods and what your expenses are. So overall, to see month by month, at least for the first year, maybe even for 2 years, looking forward and projecting what your income will be, and do a better and worse plan. So plan out for the best case scenario as well as the worst case scenario, and hopefully the middle way is the right way. And it is a management tool, so it helps you. Again, just like the business plan, after you've been in business for a couple of months, go back to your cash flow forecast and look at that and see, have I achieved the numbers I had forecasted? Where do I have to make adjustments, or is everything good and you can go ahead as you had planned?
So Volker just talked about what they look for going forward, but a lender's also going to want to look at what's happened in the past, and that's with your financial statements. So these are the basic ones: the balance sheet and the income statement. They're going to want to see, if you've been in business for a while, 2 to 3 years of history to see if there's any types of trends in it. The financial statements also contain a statement of cash flow. So that's where the financing for the business came from throughout the fiscal year and who financed the business. There can be notes in a financial statement as well. That could have details of any debt that you have or any other liabilities. It can also have details of contingent liabilities, and those are liabilities that you don't have directly, but maybe you've guaranteed for somebody else. It also might have in there if there's any litigation pending that could financially impact your business. Financial statements can be prepared in a number of ways, anywhere from notice to reader, where they're prepared based on the information you give to them, or fully audited financial statements. So your banker or your lender would probably tell you how they want to see the statements going forward.
Yeah, and they normally will want to see at least 2 to 3 years of those. And next important part is, what are the cash drivers of your business? So in your forecast, as well as in your financial statements, you will show your sales, your margins. So where can you generate the income from to service all your debts and pay all for your expenses and overhead? So of course, sales is the main driver, selling your services and products, your solutions. Then the margins. Sometimes you might not know what to put kind of margin into place. There is some from Statistics Canada. Stats Canada has some guidelines and some industry tables where you can see what in general in your industry your competitors make in revenue and what their normal margins is. Other revenue drivers are changes in your accounts receivables and payables. So how much money you have to put out and over what time frame over the next little while, as well as what money is coming in. And then, of course, changes in current assets, current liabilities, and especially capital expenditures. So is there anything you're investing in soon or have invested in which ties up your capital, and will you still have enough funds to service all of your debts and other things?
So we're talking here about lending, but there are other sources of cash or for a business to have access to funds. They include, and this may not apply to everybody, not everything would, but equity markets. So that's the stock market, issuing stocks, or venture capital or patient capital. That's longer term. That's somebody investing in your business, not necessarily being involved in your business, but providing capital. Venture capitalists usually want a higher rate of return than average. Some numbers thrown out are perhaps 25% or more, so it can be expensive. We also have private placements and public placements. Again, that's stocks. Issuing shares if you're a corporation and you may want to raise money by selling shares in your business. New partners, that's bringing in new partners to your business, and you may charge them a certain amount to take a piece of your business. I will also throw in the business plan. There's another use for your business plan, is for you to show to prospective investors or partners. And we have one called family funds or love money. Based on my experience, it may start out as love money, but a lot of times it doesn't end up like that. The key point I would make here is that if you include family and friends and you want them to remain family and friends, get it in writing. Always have it in writing. So not all of them have issues, but sometimes it can, and that would be the caution in that area. Credit facilities. So when you're borrowing, you may get something called a term loan. A term loan is usually for a specific item. Say you're buying a piece of equipment, so that'll have specific loan payment amounts tied to it to be paid off over a certain period of time. There's also lines of credit, also called operating lines of credit. Those are a bank account with a line of credit limit on it, and it can fluctuate. Usually you just write checks against your account and make deposits to the same account. So it goes up and down. That's usually to finance your day-to-day, say, receivables or working capital that you may have on a day-to-day basis. It's not to be long-term lending. There's also support in the area of government support and grants. I think I can speak for Volker when we say we get a lot of inquiries about grants.
Definitely.
There's not a lot of free money. A lot of it's tied to certain industries, but we have information on those if you needed it. And then there's also crowdfunding, which is a new way to help finance a business.
Yeah, we're actually having a question from the audience. Lisa is asking, where do I find out about available grants? One great source is canadabusiness.ca, I think is the website called. That's where all of the government has a repository of information about financing, including grants. I actually have to openly say that there is not too many grants out there for a general startup or general small business. The Small Business Enterprise Center here in Niagara Falls and in St. Catharines, they have a Starter Company Plus program, it's called, where you get some mentoring and you can get up to $5,000 in a startup grant. But that's about it. Unless you're in the agricultural or innovation area, that's where there's a lot of support and grants available. If you invest a certain amount, the government will match to a certain level the same funding. Okay. personal financials. We're talking about business financing. However, it all comes down to the people, the management of the business, as well as the people running it. Lenders are not just looking at the business itself, especially with small businesses and startups. They look also, of course, at your personal financial situation. They will ask, what is your capability of paying a loan? So they look at your disposable income, and to verify that, they will ask you to see at least 2 years of your T1 general tax summary, so the paperwork you or your accountant sends into the CRA, and then the notice of assessments you receive back from the CRA. They look at your expenditures, so they want to see what are your payments you make on a monthly basis for mortgage or rent, lease, for your living expenses, or other debt and credit payments. And they will look at your net worth. So they will want to see that you have a positive net worth. They want to see what assets, what do you own you have. So, for instance, deposit and investment accounts, they will want to see, do you own a vehicle or do you lease it? Do you have equity in your house and things like that? And then the liabilities, what do you owe? So any credit card debt, any mortgage balance, loans and lines of credit balances. They look at all of that and determine, do you have a positive net worth? Do you have a positive income? And especially with the income, sometimes with small business startups, especially if you have an idea and you want to start up, but you have a day job, sometimes it's good to keep the day job so that the income for the family is still flowing in and that they don't rely on the business right away. And then gradually you can maybe go full-time into the business.
Okay, I mentioned before, lending is about assessing risk. Again, we do it every day in our lives, deciding to take one road over another. That may be because of risk. Insurance companies assess risk, and lenders are assessing risk. And what they're looking at is the company and the management. That's the management, and we'll talk about that a little later, is more subjective, but their ability to run the business. They also look at the industry. Just by their nature, some are higher risk than others. Each loan is evaluated on its own merit, but you may be in an industry that has a history of higher risk. We talked about the financial statements and the cash flow forecasts. And something that is ever growing is environmental issues. So if you're located in a property that has, or you deal with, maybe chemicals or anything that could cause issues, the lender's going to look at that. And a quick example I'll use is a property. When I was with the bank that we were looking at, it was an office building, but when we did the research, it used to be a car dealership. And for those that don't know, and I learned this, way back when they did oil changes, they threw the oil into a pit in the bottom of in the ground. And so there was potential environmental issues, and the cost to deal with this can be substantial. If you take on a property with the environmental issues, you can be held responsible, and any lender who lends to that property can have some liability as well. So an ever-increasing area. Access to funds, so how readily available. You want the loan for this specific purpose, but are there loans, or are there funds that are available for some contingencies that might come up or cost overruns? So how readily is cash available? Early warning signs. This could be change in rules and regulations in your industry or with your company as it relates to your financials. Are your accounts payables getting up there? Are they increasing? Is there a lot of cash coming out of the business? Is your HST and your payroll deductions, are they up to date? That's an early warning. If they're not, that's an early warning sign that there could be a cash issue. And then they assess based on the security that's available for the loan.
Yeah. Another risk assessment portion is the risk rating. So where banks will actually and lenders will look at your industry, like Steve mentioned, but also at particular companies. So if you're dealing with a large supplier or one of your clients is maybe even Fortune 500 companies, they will look how stable are those companies, right? So you've probably heard of Moody's, which does credit risk ratings for provinces and other ones for countries. The same is applicable for large companies. And another part is, of course, credit bureau. I mentioned before in regards to the personal finances that lenders will look at that. And to one of the most important piece of papers they look at is your credit report. There's two major companies in that realm here in Canada. It's TransUnion and Equifax. And they show your financial history on your credit report. One is the most important one they look at is the beacon scores. You probably, if you've got mortgages, you've looked at that, then they'll say, oh, it has to be at least 650, 680 or higher. That's very important. And with the beacon score, what you should keep in mind is there's two big impacts on the beacon score. One is that you make at least your minimum payments. So you will want to at least pay what the statement on your credit card says as the minimum. If you can pay all off, even better. But otherwise, it's also if you go out and seek credit. So if you're going for a mortgage, if you're looking for a new mobile phone, or if you're looking to get a car, you will have assessments done for you, and if you can qualify for the purchase of the product or of the mortgage. And every time the bank, the car dealership pulls a credit rating, you lose about 5 to 7 points. So if you go and shop around, you can lose points fairly quickly without even knowing. So it's good to be aware of those things, and then take advantage and go to TransUnion and Equifax, and maybe on a yearly or biannual basis, pull your own credit report to see where you stand, so that before you go in and see a lender, that you know what is on your credit report, and you have the knowledge to answer any questions they might have about your report.
We have a question here. It's how long will it take to be approved for financing? Well, every deal is, individual, and some may take longer than ours. There's nothing wrong with asking your lender for a commitment from them. What they likely will say is that once we have all the information that's requested, so you've heard some of the things that are required, an accurate assessment cannot be made until all the information is received. Our organizations, for example, report to a board of directors, and where I am, we send the application. I recommend it. We send it through to our board, and they make a decision on it. With other lenders, banks, credit unions, they should have some type of timeline that they're able to give you. I'm going to bring the business plan back in again. You should be able to, if you're working to your business plan, these shouldn't have to be rush deals, coming in on a Wednesday and saying, I need the money by Friday, because that's also going to, show them ability to run the business. I mean, things do happen. So as far as time, ask your lender and make sure you get them the information that they're asking for as soon as they can. We're going to go to the next section, which it's called the 5 C's of credit that lenders look at. And the first one is character, and this is more subjective. We do have, talking about the financial statements and the numbers, but this is the subjective part. The lender's getting an idea of how you are as a business owner or a business operator. They're looking to, it says there about sufficiently trustworthy, but they're looking at your ability to execute the business plan, to do what you say that you're going to do. Do you have the educational background? Do you have the experience in business? This is especially important for new business startups. What's your background? Because they are lending based on projections. So this is your best guess of what could happen. The quality of your references and the background and experience level of your employees. They could also assess you through the loan application process. So meaning that how you presented yourself in the loan interview, how organized you are in getting the information to them, how cooperative you are with them as well. So again, if it's a rush, that not necessarily a negative because things happen, but how are you handling that process as well? It gives an idea as to your character.
Yeah. And with the character comes also the capacity. So to show, again, like I had mentioned before, the disposable income, the same is for your company. Where are the sources for you to repay any debt servicing? So for a loan, do you have the cash to do that? How will you generate that cash? Do you have any money you can fall back on? It's can be considered one of the most important, again, is the cash flow forecast and the cash flow from the business, the timing to do the repayment, as well as the probability of successful repayment. So is your business plan, sound and solid, and will you be able to generate the monthly income to pay back the loan the lenders will provide to you?
The third C is capital. So capital is the money that you personally have invested in your business. It's how much risk you have from a financial point of view. So we talked about this being risk assessment. And capital is about sharing the risk. They'll expect you to have contributed something into the business in order to share it. You don't necessarily need to have the same as what you're looking to borrow, but you need to have some. And if you haven't experienced lending, think about insurance, for example. You usually have deductibles. They want you to have something into it. So some financial, commitment to the business as well.
Exactly. And then the conditions. That's the fourth point of the 5 C's. Conditions meaning describing your intent or purpose for the loan. So what will you be using the money for? Is it for working capital, to help maybe hire some new staff, or to pay for inventory and equipment? Is it to do a bigger new project, some machinery you need? Or is it actually to refinance debt? I mean, a lot of lenders don't want to take over the debt which is already another lender has, but sometimes it makes sense to consolidate debt and get maybe a better interest rate, or just other better terms and conditions. And the lenders will also consider the local economy, right? The conditions, the overall climate within your industry, as well as external factors which might affect your industry.
We have a question, and it's, do I have to provide collateral? And that leads into the 5th C of credit, which is collateral and guarantees. And the question is, do I have to provide it? Again, it's an assessment of the risk of the business. So if the business itself cannot support the loan through all the previous 4 C's, then collateral or guarantees may need to be provided. The collateral means that you're going to pledge an asset that you own, such as your home, and I know not everybody owns a home, but it can be some type of asset that you put up in case the business can't repay the loan. A guarantee is it's a personal promise to pay, and a guarantee, if you're a sole proprietor, you will be signing personally anyways. If you're a corporation, you will very likely be asked to put up your personal guarantee, your personal commitment to making good on the loan if the business isn't able to. Also, they could require you to put up a supporting asset in support of your guarantee. So if you had a home, they want your guarantee, and they may ask you to put the home or some other asset up. A point I want to make here about collateral is lenders look at what's called the lending value of an asset. So if somebody says, I want to put my car up as, I have a $10,000 loan, I want a $10,000 loan and my car is worth $10,000. So we ask people to look realistically at that. So that's what you could get for the car. But lending value looks at what the lender could reasonably get for that asset. So let's say the car loan didn't work out, you weren't able to pay it back. So the lender actually has to go get the car, store the car, maintain the car, sell the car, and when somebody finds out that it's not being sold by the owner, if you were to buy something, in liquidation, whenever you go to these stores that are liquidators, what you expect to pay less perhaps than retail or market. So what can the lender reasonably get for the asset? So don't be offended if the value they assign to it doesn't equal what you paid for it. It said you have to provide collateral. If you don't want to provide collateral or you don't want to guarantee the loan to the lender, what message do you think that is sending to the lender? If the owner of the business is not willing to put up their personal commitment, should the lender wonder why they should put their money behind it? So your guarantee and your signature and perhaps some assets, that's your personal commitment to the business as well. We were talking about security, the security types, and there are many. We're just going to cover a few. Part of the security is a promissory note. Even to go back to the family and friends lending to you, I had this experience personally, and maybe it's just because I worked in the bank. We had a loan document done up just so it doesn't create any problems, that there's no misunderstanding between the two parties, no matter what the relationship is. It can prevent a lot of problems. But a traditional lender is going to expect to have a promissory note. We've talked about a guarantor or personal guarantees. We have something called a general security agreement. That covers assets of your business, such as inventory, receivables, some equipment, and other assets of the business. This security is registered under the Personal Property Security Act. It's a registration process where other people can see things that have been registered. So it's a central registry for general security agreements. Covenants or restricting actions. So your lender may ask you to agree to things such as not taking dividends from the business or limiting it, the amount of equity you can take out of the business because they want to ensure the risk remains shared, sale of shares or bringing in new partners to your business, and taking on additional debt. Collateral mortgages. So when you purchase a home, you take out a mortgage. So they put a mortgage on your home, they give you an amount of money to buy the home. A collateral mortgage is a lien against the equity in a home. So it's just a lien. It's not taking money out of it, but it's a lien against the equity. Depending on the situation, a spouse may be requested to provide a guarantee. Perhaps you own your business and your spouse owns the home that you live in. You've done that for certain financial reasons. Your spouse may be requested to guarantee as well. And it says here, including ILA. ILA means independent legal advice. What this is, since they're not realizing direct benefit of the funds, it'll be requested that they go to an independent lawyer and get advice on doing this transaction. So the lawyer will spell out for them. And the lawyer is independent of the lending institution and the person borrowing the money. may require life insurance on key management. So that's insurance to pay any debt should something happen to a key person in the business. And a landlord waiver. That can cover things like having access to the business. So if a business can't pay and they've been locked out by their landlord, how does the lender get access to inventory or equipment in there? So they may want to see, that they will have access to it. In terms of if you're renting spaces as well, if you're asking for a loan to be over 15 years, but you have a lease for 5 years with no options, that could come into affecting your loan as well.
Yes. And for the securities which you're pledging, there are, of course, charges. So Steve mentioned that the registration under the Personal Property Security Act, where any collateral, meaning equipment or inventory or your accounts are taken a lien against, as well as the collateral mortgage on a house, you can ask for discharges of that. So ask your lender after a certain time, because maybe you plan the house you're living in, you pledged as a security to make renovations and need funds from the equity to do that, or you're planning to sell that in 2-3 years. You can ask your lender, what do I have to do? What performance do I have to make that these charges are being discharged and the liens are taken away? Normally, it's, of course, positive repayment history, that you pay on time the agreed on amounts, the business profitability, so how good is your business running, and then, of course, the management plan itself, how you're managing the business. And be aware that there is associated costs. When you get the financing and a lien is put against your equipment or a mortgage charged on your house, you will have legal costs. And the same will be at the end when you pay off your loan completely. Then there might be discharge fees, legal fees, which play into the matter too.
Okay. Once you're approved for the loan, this would come into play as the terms and conditions, and I believe it's the same as for your organization,
Yep.
that a commitment letter is provided. So it is a formal letter with all the terms and conditions spelled out in it. And that includes how much the loan is, what it's for, what the interest rate is, how long it's over. So the first item says disbursement or access. I know in our letter it says that no funds will be advanced till all required security and all the information has been received. Talks about the interest rate. So the interest rate is indicative of the risk of the business. And again, I kind of relate it to insurance. The higher the risk you're perceived to be, the higher your premium would be. So the higher the perceived risk to your that your loan represents, the higher the interest rate would be. And I checked just yesterday, the banks, the credit unions, I know we use, is what's called the prime lending rate. And that's the base at which lending institutions start. It's currently 3.45%, and they'll add points to that. So prime plus 1, prime plus 2, whatever it is. And you're able to try to negotiate that as well. I know in my banking days, we had them at certain rates. If the perceived risk went down, we were willing to negotiate interest rates went down. If perceived risk goes up, this is something that may change. Just a little bit of trivia. Back in August of 1981, the prime lending rate got to 22.75%. So these are pretty good times for borrowing. So term and amortization. So the term, again, some people might be more used to, maybe personal mortgages. Mm-hmm. So you might have a 5-year term on your mortgage, which means that interest rate perhaps is guaranteed for that 5 years. but you're paying it off over 25 years, which is the amortization. So the term is the current agreement terms for the loan. The amortization is how long it will take to pay the loan off in full. There could be repayment restrictions. Is it an open loan? Can you pay it off at any time? Or is there a penalty to pay it off early? The fees can apply. Can be fees to set up the loan, to register security. There's a fee with the Personal Property Security Act registration. Legal fees for registering mortgages can apply. And terms and conditions will spell out the security. So you should get a commitment letter, some type of written document spelling out everything that the lender is expecting, and you agree to it, and you'll be asked to sign that as well. So you should know everything before you actually receive the funds.
Exactly, and sometimes interest rate isn't the most important, right? Sometimes the repayment restrictions might be even more favorable, that you pay maybe a half point higher interest, but you're able to pay it back faster. In regards to sources, so where can you get some additional business advisory services or financing resources? One of the advisory services, of course, and it's not mentioned on this screen, but I will mention, is the South Niagara Chambers. Just like these online webinars, they provide you some information with how to do your business, how to run your business, and other things are the Niagara Falls and St. Catharines Enterprise Center. We're right now in the Niagara Falls Enterprise Center, Small Business Enterprise Center, and they have what I mentioned before, the Summer Company Plus Starter Program, where they provide a small grant if you are approved. They have the Summer Company for students, as well as the Futurepreneur Program. Especially for women who are interested in starting up businesses, the Welland Heritage Council and Multicultural Center and the Niagara Women's Enterprise Center in Welland are very good resources, or have very good resources to assist you. Then we have various incubators here in the region. There's Innovate Niagara down on 1 St. Paul Street in St. Catharines. We have iHub from Niagara College in the educational space. Spark Niagara, which is just down the street from here in Niagara Falls downtown, and they just opened a second location in Beamsville. And of course, BioLink and NC Takeoffs, the incubators of Brock University and Niagara College. I, in the beginning, mentioned a good resource about grants and other financing to find out, and business plans and things like that, is also canadabusiness.ca, a government website with a repository of information of how to start up and run your business. Then in regards to talking about grants, as I mentioned, there aren't that many around, but there's pitch competitions and awards. So if you are a startup and you're doing very well, or accomplished small business owner, you might be one of the next recipients of the Niagara Entrepreneur of the Year Award, the NEA Awards. There's the Ignite Niagara event, as well as the First Ontario One Awards. And then in Thorold, that's where our office is located, there's Shannon Passero, a businesswoman who also gives awards to local women who run businesses and recognizes their accomplishments. Another resource, and especially I think in regards to the talk of the increase of the minimum wage, what a lot of small business owners don't know, there is help for staff pay wages. So subsidies if you hire someone on, where the Ontario government provides funding for that. And there's several organizations who facilitate those programs. One is the Job Gym, the YMCA, and Niagara College. They run those programs. And then there's also one which is called WorkLink, which provides actually people with disability of finding jobs and funding for potential employers. And then Start Me Up Niagara. So if you are a person with disability and are looking to start up a business, there Start Me Up Niagara has a financing program with a partner called RISE. So there's all different help available and resources available throughout the region. And more closely in regards to the business or in the financing part, funding resources, there's of course the 5 big banks, so the banks and the credit unions. And most of them actually work with what is called the Canada Small Business Financing Program. That's a federal program where you can get a loan from one of the big banks or the credit unions, depending that they work with that program, where you can get up to $1 million or a project of buying a property or a commercial unit up to $1 million, and where the government secures that loan up to 75%. So the banks really like that. Or if you're looking at equipment, they finance up to $350,000. Now, there's of course also mortgage brokers, which not only provide mortgages, but sometimes they have actually private lenders which are looking to invest in small businesses, and that might be a source for you as well. Then, of course, the Business Development Bank of Canada, the BDC, where I think Steve, your office and our office worked with them together, where we partner on certain loans and have had great opportunity there with several loans even this year for us. The federal government with the BDC are really pushing certain sectors, I think, especially for newcomers as well as clean tech. Then there is, of course, the Niagara Angel Network, so angel investment, equity investment, and as Steve mentioned earlier, crowdfunding. So for small businesses, it's more, I think, Kickstarter is the main portal there. But there's, of course, also GoFundMe, but I think that's more for social causes. And then there's several different federal or provincial organizations. So FedDev Ontario, which is our office's funder, they provide direct funding through a program called SOFI, that's the Southern Ontario Financing for Investments in Innovation. And they have something called Investment in Business Innovation, IBI. So that's for early start on if you have a new manufacturing process or something like that, which you want funding for, that's where that can come from. And then there's something new in the agricultural industry called the Canadian Agricultural Partnership, which is run by 3 entities, OMAFRA, ACC, and OSCIA, so all agricultural institutions, government ministries or associations, which provide funding to certain projects, not only to producers, so to farmers, but also processors in the agricultural food and beverage industry. And then, of course, Farm Credit and Agri-Innovation, to mention a couple more in the agricultural side. And then Canada Export or Ontario Export. Very important, if you exporting any goods outside of Canada and you're looking to get those products insured for the delivery, the Canada Export and Ontario Export can do that, as well as they also sometimes finance that. We had a client recently who actually got financing from Canada Export to produce their products, which then were shipped overseas. So it's not just a traditional lender. There, the government will help. And then, of course, Venture Niagara and the Fort Erie Business Success and Lending Center, we are there as well to provide you with funding.
I think the point of all that is that there is assistance out there. We would even offer that, you know, if you were going to your own financial institution and wanted assistance with presenting a loan application with what's needed, I'd be glad to help you with that as well. We want to provide some cautions. We use the term traditional lenders, which include our organizations, banks, credit unions. There are other ways to raise money, and just some cautions with those, no specific companies mentioned, but paying a fee to somebody to prepare a loan application or an agreement, you shouldn't have to do that, not with all the resources that Volker mentioned and with our organizations. People are also using payday loan services for financing, which can be expensive. There's online providers, so you may see I saw one get up to 300,000, and you apply online. And again, this may be a source for you, but make sure you're checking everything out. Businesses are relying on credit cards. The interest rates can be very high for that. There are grants, but they are rare, and they may be for specific sectors. If you're going to deal with an organization that you're not familiar with, do a reference check on them. Google the person or a business. And again, I mentioned that we provide commitment letters that'll have all the details of it. It can be a few pages long, but I encourage you to read the documents, no matter who you're dealing with, what we call the fine print. And another thing, it's the old saying, if it sounds too good to be true, it probably is, and that applies to lending money as well.
Exactly. And in regards to the payday loan services, everywhere you see the 300 for 20, so you get $300 and pay $20, and that's for 14 days. The $20 is what you pay for 14 days. If you extrapolate that into over a year, you would pay an annual interest rate of 173%. So it is really important to look at your finances, and I think talk with your lender. Let us know, or let your lender know, what are the positive things in your business, but also what are the negatives. If you hit roadblocks, there are experts out there. One of them is maybe your lender who can help you with the financing. So that's where we are at the takeaways we want to give you for today is, key is to understand, as it said in the beginning, but not necessarily agree with your financial institution. Right? Get to know your lending partners so that you know how they affect you and your business. Build rapport with them. I always say, having worked in the bank just like you, Steve, before, there are so many changes. People in the staff in the branch switches so often. Your financial advisor, your financial service representative, you're there one day, the next week they're gone. They've transferred to a different branch or moved to a different bank. So I always say, build a rapport with your branch manager. They mostly stay for 2-3 years, but the head teller, very seldomly the head teller moves. They know the ins and outs of the bank, and they can advise you with which advisor to speak to. And then, of course, the knowledge gives you power in present and future negotiations. So with all of that knowledge, with your preparation, before you go in to see your lender, it will really help you in your negotiations with them. And be prepared. Have your documents packages ready. So all of the papers we talked about, from the business plan to the cash flow forecast, your financial statements, your tax papers, your overview of your mortgages, things like that, have that all ready and in a nice, succinct way that you can give that to your lender, because that will make their job much easier. So we're almost at the end here of our presentation. If you have any other questions about the takeaways or in general about the presentation, feel free to ask them now or to reach out to us.
There's no other questions. If I can just add as well, in my past, some people have mentioned that applying to a financial institution for a loan can be an intimidating process. All I'll say to everyone is, you're the customer. You're offering a financial institution the opportunity to do business with you. So they should be welcoming to you and knowledgeable with what they're talking about, and if they can't, they should get you to the right person, but you are the customer offering them business. There are no other questions. Just want to say thank you to the South Niagara Chambers of Commerce, to the Niagara Falls Small Business Enterprise Center, and to Volker as well for allowing us this opportunity.
Yes, thank you.
Thank you.